Okay, now let's take a look at some of the other tools with Hercules. You see there are three tabs at the top of your screen: Currency Strengths, Position Sizer, and Planner. Let's take a look at the Position Sizer. You can see here I've selected Pound US Dollar. For now, the Pound US Dollar, US CAD, all of these are going to come up with the same results, but you can choose whichever one you want. We'll just go ahead and keep it at Pound US Dollar. What you want to do is enter in an account size. Right now I've got $50,000 in the account. You then want to take a look at or enter in your maximum trade loss. That, as a percentage, is how much of your account you're willing to lose on any one trade. And you can see here I've got 2%. Now that's going to come out to $1,000. Then I want to place the stop loss of the trade that I'm looking to take. Now, what this will do is give you the ability to plan how much money should I put on this next position. So let's say you're looking to go long. Okay, we're looking at the British pound. You get the line. We have a triple bottom. Let's say, for example, I'm thinking, hey, the market looks like it's going to bounce to the upside. I'm going to go ahead and take a stab at a long trade. So I can go back to Hercules and I can say, well, how much of my account should I risk? Well, if I'm willing to risk 2% or $1,000, and I'm willing to take a stop of 35 pips, what does that mean in terms of position? So let's click on Calculate. Then you can see here that I've got this answer, 2.86 lots. How did we come to 2.86 lots? Well, we came to 2.86 lots by first entering the number 1 right here in the Scale In Relative Sizes box. And then we entered in a number 2 here. Now, in a moment I'll explain why or what both of these mean. So you can see here it's got entry number 1 at 2.86 lots with a 35 pip stop is going to equal a loss of $1,000. So this would be 2 regular lots, 8 minis, and 6 micros if you wanted to be exact. Or you could just round this down and enter in 2 regular lots. Now let's say I wanted to risk 50 pips. I'll go ahead and click Calculate again. You can see what's happened is it's gone down to 2 lots, because 2 lots at 50 pips is going to equal $1,000. So the most I could trade on this particular trade, if I was looking to go long right here, would be 2 regular lots. Now let's say I didn't think that I could pick the exact point of the reversal. So let's say we can see that the British pound might trade a little bit lower. So we're willing to enter a little bit as the market starts to go down. Let me back out here. We'll scrunch this down. What this means is, instead of entering in all of the position at the 1 point right here, we're going to take it in stages. So we might enter in some at this point, some just a little bit lower, and some just a little bit lower than that. That's called scaling in. Okay, scaling in. This is not dollar, DOLLAR, cost averaging. Okay, that's not what this is. Dollar cost averaging, if maybe you've heard that term, basically it's an excuse to continue buying something as it goes down. So it's not that you're buying it in a very, very tight range of prices. You'd buy some up here, some way down here, some way down here. You just keep buying it and buying it and buying it. That's not what we're talking about here.